best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And you are listening to the Financial Survival Network. It's Kerry, Lutz. And with us is Jason Hartman. You know him well, jasonhartman.com. He's the one who's got the cure for financial repression. Part of that strategy is something he calls Refi Till You Die. And understand the strategy here, don't do it with your primary residence if you happen to own it, although there might be strategies that work there as well. We're talking about income property here. Jason, been a while. How you been?
Hey, good, Kerry. How you doing?
All right. Just got back from a weekend in snowy New York, first day of spring. And of course, there's a snowstorm, but I was staying like right by Central Park, and I've got pictures I'm going to put up on the site.
Surely all that snow in the Northeast was caused by Al Gore's global warming scam, right?
Oh, God. And it's amazing how many people just believe it without any question. I'm in this discussion group, and nice enough lady. I said, do you know the only country that's complied with the Kyoto protocols? You remember those?
Probably the U.S., right? Yeah, I remember
the treaty, Al Gore went there, and it was a bunch of BS, and we're going to cut back to, the U.S. is the only country that's complied with it. Not that we went out to comply with it. It's just a question that many of the electrical plants before Obama went native on coal had switched to nat gas. Why? Because nat gas is so much cheaper than any other form of energy production for electricity. It made total economic sense. So when new plants need to be built, the default is nat gas. And as a result of the fracking boom, which has made nat gas so affordable, the U.S. is in compliance with Kyoto. Also, the fact that deindustrialization of the U.S., I didn't get into that, and she's saying, no, that can't be true. It's because of other things. I said, go look it up. Don't tell me how you feel. Go look at the facts, and then, we'll have a discussion. Of course, I know you're back from it, but you know how that is.
Yeah, definitely. It's tell a big enough lie long enough, everybody will begin to believe it. I've done several shows on it myself, but that's the way it is. Yeah. Right. Well, hey, so one of the questions I get a lot here is on, Jason, if I'm going to, people say to me, Jason, you recommend leveraging my properties, leveraging my investment portfolio as much as possible. And I definitely believe in leverage as long as it's prudent, long-term investment grade debt. It must be fixed rate debt, in my opinion. And that makes a lot of sense. When you leverage it, you diminish cash flow, of course, but you have lots of extra cash that you can acquire more properties with and have a bigger portfolio, control more real estate. So many people understand the benefits and the pitfalls of leverage. Of course, we've seen many people get themselves into trouble with debt. But the question I always get, Kerry, is how do I extract the wealth from my portfolio? What is the most efficient way? If I'm not investing in these crazy markets like New York, where you just got back from snowy New York, where you might, if you're lucky and you catch the cycle properly, you might see big capital gains. So of course, you may also see big capital losses in all of those cyclical markets like that. It's a roller coaster ride. It's big ups, big downs. It can be very ugly, but it can be very, very nice at the top, right? And so if you invest in these linear markets that produce income and are very reliable, they just chug along, they appreciate slowly and consistently over time, where's the big bang? What am I going to do to really create a bunch of wealth for myself? And so my answer to that is called Refi Till You Die. It's the most tax efficient and wealth efficient way to extract that wealth from your portfolio. And I'm going to run through a bunch of numbers when we go through this example today, Kerry. And so you're going to share that in the RSS feed, I believe, right? I'm going to send you a PDF on this so listeners can actually see this and see the printed version of it, right?
Yeah, sure thing.
Okay. So do you want to tell the listeners how they get a hold of that?
Yeah, it'll be on the site. You just click it and You'll be able to download the PDF with all the examples that Jason's discussing now.
Good stuff. Good stuff. So let's take an example of someone who has or wants to create a $1 million real estate portfolio. And this is just an example. Of course, it's subject to qualifying for the loans. Of course, costs will vary a little bit. It's a very rough, generic example. Okay. But here's the example nonetheless. $1 million portfolio, properties in diverse markets. I would recommend that investors be in at least 3 markets, not more than 5. And, you want to diversify because if you invest in, say, Memphis, Tennessee, or, an area in Florida or an area in Texas, you don't want to have all your eggs in one geographical basket. The old saying in real estate is that all real estate is local. All real estate is local. And it really is. So we say to investors, take the most historically proven asset class, income property, and really there can be no winning argument against that. There is nothing else that has created wealth for tens of millions, if not hundreds of millions of people just in the United States. I mean, if you look at the last 4 decades with income property, probably hundreds of millions of people just in the US alone, okay, because there's 310 million now, and over time have created significant wealth through income property. You look worldwide, and I would venture to say it's probably the most historically proven asset class worldwide. Nobody has done that in the stock market like that. Nobody has done that with precious metals like that. Income property, it's the most historically proven asset class. So diversify geographically into 3 different markets, a $1 million portfolio subject to qualifying with 20% down. That'll be $200,000 down. We'll estimate closing costs, which will vary, of course, depending on market and the type of loan you choose at 3.5%. So that's $35,000. And reserves, you need to keep cash in the bank as reserves of 4% of the value of the portfolio. That's my minimum reserve requirement. And you want to keep these reserves to be a good conservative investor and not ever be in the position where you're forced to sell a property at an inopportune time. So have reserves of $40,000 minimum or 4% of the value of the portfolio. So the total there is $275,000 to control $1 million worth of income property in diverse markets. Make sense so far?
Yeah, sure.
Good,
Definitely.
good stuff. So, there's a lot of numbers here. So slow me down, please, Kerry. So, I know people are just listening in terms of audio here. And of course, they can get the printed copy of all of this. But the numbers are going to become a little more extensive here. So there's something your listeners and you have all heard of. I mean, you're a financial guy. So you've certainly heard of the rule of 72s, right?
Of course, sure.
So the rule of 72 says that at 6% appreciation, which is arguably the historic average for real estate nationwide, depends, of course, on the time period, but, over long term, about 6%, even a little better, maybe some would say. So you take a $1 million portfolio, and at 6% appreciation, it will double in 12 years. So if you have, most people, by the way, I think I started another show called the Longevity and Biohacking Show. And I've really been quite interested, as I'm aging myself, in longevity sciences. Yeah, we all are. We can't, none of us will get out alive, right?
Yeah, nobody gets out alive, as Jim Morrison said.
Yeah, absolutely. And but he's still alive. Jim Morrison. He's the singer for The Doors, folks. If you don't know who Kerry's referring to,
him and Elvis. They're both.
Yeah.
They went home.
We're going to see Elvis soon because we're doing a Memphis property tour here in about just a month and a week. So we're going to look for Elvis at Graceland there. But most people, the problem they're going to have is too much life left at the end of the money. So what we want to do is we need to plan very diligently. And we need to remember that this age thing ain't what it used to be, as the expression goes. So let's take the example of a person who's 40 years old now. If you're 50, you're 60, whatever your age is, the same thing applies. And before you know it, you can amass some pretty good wealth here and some pretty good income on which to live. So you take your $1 million portfolio, you're age 40, And by the time you're 52, that portfolio is now worth $2 million. So you've had a $1 million gain on the portfolio, and nobody knows what the future will hold for bank lending and so forth. But say that it's about the same as it is today. It may be easier to get loans. It may be harder. Nobody knows what it will be like in the future. But you go to the bank 12 years from now and you say, I've got this $2 million portfolio and I want to refinance on an 80% loan to value ratio, 80% LTV loan to value. And so the bank says, okay, we'll give you loans for $1.6 million. Now, just remember, when you were 40 years old in this example, you started by putting $235,000 in to acquire the portfolio. You kept $40,000 in cash reserves, and your loans totaled $800,000, and your equity was $200,000. That's how it looked when you started out. And just 12 short years later, that time will pass anyway. You might as well be investing and making your money work for you. You've now got a $2 million portfolio, and you're going to increase your loans to $1.6 million, and you're going to double your equity to $400,000, and you're going to have $800,000 in cash. And guess what, Kerry? This cash is tax-free because there's no tax on borrowed money. That's the beauty of it. If you were to sell properties and just liquidate the portfolio, you would pay long-term capital gains tax on the portfolio. So we want to be tax efficient. We want to borrow against the portfolio and keep the golden goose. We don't want to kill the golden goose and eat it. We want to keep it because it keeps laying eggs. And these eggs become just golden, and more golden over the years. So now, if we take that $800,000 and let's say we don't listen to the Financial Survival Network and we don't know how to invest, we take it and stick it under our mattress. All we do is take $800,000 and divide by 12, getting zero return on the money. Now, of course, everybody listening is going to be much smarter than that. Hopefully, they're going to buy more income properties and increase the size of their portfolio. But say they don't, they just stick it under the mattress. $800,000 divided by 12 is, I'm rounding off here, but it's $67,000 per year, and that's tax-free. So I would venture to say that $67,000 tax-free is worth about $100,000 taxable, depending, of course, on your tax bracket and the state in which you live and so forth. Okay. But now we've got basically the equivalent of about $100,000 per year to live on. Okay. And we're only 52 years young. Now, let's go 12 more years, and we're now 64 years young. And by then, 64 is the new 40. We've now got a portfolio that's worth $4 million because by the rule of 72s, it has doubled again. And we've got a $3 million gain. We go to the bank, we say, hey, banker, I want to borrow against my portfolio at 80% loan to value. Give me $3.2 million in loans. And I'm going to double my equity position again. My equity that started at $200,000 and went to $400,000 on the first round is now $800,000 in equity. So my equity keeps getting larger, and my cash out proceeds from the second refinance of the portfolio is $1.6 million. Now I'm going to take that $1.6 million, stick it under the mattress, earn zero return on it. I'm simply going to divide $1.6 million by 12, and I'm going to get $133,000 per year tax-free. And that will be equivalent to, by then the tax bracket will probably be so much higher. That'll probably be equivalent to 200 and something thousand per year taxable, maybe even more. Okay. So yeah, what questions do you have? Please stop me, ask questions, because there's a couple things you can pick this apart on, and I want to bring those issues up.
Well, okay? Will mortgages even be available? B,
we don't know.
Have the appreciation? Will that
we don't know.
occur? We don't know about that.
Yeah. All a projection.
Uncertainties for everything. Yes. Let's face it. But
there are uncertainties.
Been, like you said at the conference, and you said before, you've looked at markets all over the world. the only reliable one of the bunch is the U.S. property market. I don't see China becoming reliable. I don't see Europe with its current turmoil becoming reliable. Canada, maybe somewhat.
But the problem with Canada is it's too expensive already. Nothing cash flows there. I have a lot of Canadian clients that buy property through our network, and they just can't make it work up there. Yeah, same with Australia. Yeah. So, good points. No, when you look around the world, as much of a disaster as the U.S. is, it's really pretty good compared to a lot of other places.
That's the pathetic part.
Yeah. It's really kind of a pathetic statement. We're just the least worst out of the bunch, for big countries.
Yeah, the best looking horse in the glue factory.
Yeah. Well, hey, if you're going to be in the glue factory, take the best looking horse.
Yeah, that's it. My best friend, his family was actually in the glue business, still is in the glue business. It's a couple 100-year-old business. It was a byproduct of being in the hat business. I don't want to get into the whole thing, but the glue business now there's a lot of synthetic adhesives, but you still need glue for certain things. And you know what?
And glue is really made from horses. Isn't that awful?
It's made from bones, from animal gelatin. It doesn't really matter which ones you use, but
do you realize that we are offending all the PETA people right now? And I love animals, by the way. Don't get me wrong. Yeah, I'm not a vegetarian though, but yeah.
I met your dog. You give a great.
My dog is
Coco.
Awesome.
I love Coco. So.
She's very popular. She has her own Facebook page.
Yeah, I didn't know that.
Well, you can friend her. Coco Hartman.
Sure.
Yeah, look her up. I
will. So
it's very popular.
But okay, so it's a necessary fact. If you want, you can't have modern life without silver. You can't have it without glue. It's just a fact of the matter, because sandpaper, in order to adhere the particles to the sandpaper, you got to have glue, and most adhesives will not work well enough to replace it. So it's one of those things, whether you like it or not, got to have it.
And Kerry, my listeners accuse me of getting off on tangents.
We're talking about glue factories here, so it's not a total tangent. But
that was pretty awesome. That was
seriously.
See, folks, you didn't know today you were going to get a science lesson, right?
Yeah.
We talk about global warming, glue, and Refi Till You Die real estate investing. Okay, so
and they're all connected.
Let me pick this apart. Let me be my own skeptic here, okay? Here are the problems with the Refi Till You Die theory. And they're really not problems, but they are questions that a lot of people bring up. They say, first of all, they'll say, well, hey, Jason, if I keep refinancing my portfolio like that, won't my debt service go up? Won't my payments go up? Well, probably. I mean, if interest rates are higher, and I think they may well be higher in the future, that's why I think it's such an incredible time to lock in 3-decade-long fixed rate debt. That debt actually becomes a huge asset to the investor, okay? So I do think rates will be higher in the future, but just remember, this is really the theory of relativity. It's all related. People need housing. The population is increasing over the next, what is it now? The next 35 years. I used to say the next 40 years, but it's later than I think. It's already 2015. Over the next 35 years, the U.S. will add almost 100 million people to its population. And everybody needs a place to live. Everybody only has 3 choices. They can buy, they can rent, or they can be homeless.
Right.
And given those 3 choices, they always seek out relativity. So if interest rates go up, developers stop building, housing supply remains level, population keeps increasing, and you see upward pressure on rents. Okay? So these things are all related, and historically you can totally find that there's ample evidence for all of this. This is not some theory. It's actually happened over decades of time. So your rents will keep pace with the debt service on the portfolio, so long as, and this is very important, so long as you are investing in linear markets, not cyclical markets. And what I mean by that, and you've heard me talk about this on prior shows with Kerry on Financial Survival Network, but and on my show as well, is that the linear markets are the markets you don't hear about on the news. They're not South Florida. They're not the Northeast. They're not California. They're not even the Pacific Northwest anywhere, whether they're Washington State or Oregon State. Those markets are too expensive. They're places like Texas, Tennessee, Missouri, Georgia, these types of markets. And you can find those all at jasonhartman.com in the properties section. Those markets produce great cash flow and they have nice, consistent appreciation rates. They're boring. You don't hear about them on the news, but that's where you see these characteristics where rents keep pace with inflation and debt service concerns.
Yeah.
So given that, on the next skepticism of Refi Till You Die would be, well, how do I know financing will be available in 12 years? Well, you don't. Okay, I understand that you don't. But remember, if financing isn't available for you, it's not available for anybody else either. It's not available for developers. It's not available for other investors. And it's probably not even available for home buyers. So what does that do? It puts upward pressure on rents. So your rents are going to increase. And that's why I love income property, because it's a multidimensional asset class. Whatever the case is at the time, you can adjust your strategy. If you've got big capital gains, you might want to sell properties in your portfolio and just take your cards off the table and take your profits. If rents are up, you just sit back and milk them for cash flow and mailbox money. And, it's just a phenomenal asset class. Nothing beats it. So do you want to go one more cycle, Kerry? Do we have time for one more 12-year cycle?
Yeah, sure. We got
Okay. All right. So this investor now is only 64 years young, remember? Okay. And if you don't believe me that that's young, I just challenge you to go watch, turn on your Netflix account or your Amazon Prime account or your Hulu account and go watch a movie from the 70s and see the depiction of a 40-year-old in the 70s versus today. It's just a whole different ballpark, okay? It's not just about lifespan, which is increasing dramatically, and we're on the verge of huge breakthroughs there, but it's also about health span, okay? So now this investor in 12 more years is only 76 years young, okay? And their portfolio has doubled again. It's now $8 million. Oh, one more skepticism I want to bring up, adjusting for inflation. Of course, $8 million won't be what $8 million is today. That's true. I agree. But with the inflation-induced debt destruction wealth creator that I've talked about on other shows, and you know how I talk about what I call the double inflation arbitrage, okay? I know those two phrases are like a mouthful, but they are very effective. Your debt is actually being debased by inflation. So you're not even paying your own debt. You're outsourcing it to your tenants, right? We don't even pay our own debts with income property. We outsource them. Our tenants pay our debts for us. But also, inflation is continually debasing the debt and making us more and more wealthy because, well, the property portfolio may roughly keep pace with inflation or outpace inflation by a little bit. And, it's a great hedge against inflation, as everybody knows. The debt is being debased by inflation. And since you only have 20% equity to control a portfolio at a 5-to-1 ratio, you're controlling 5 times the value of what you put into the deal because you only put 20% down, right? You're increasing your wealth at 500% the rate of inflation. You're arbitraging inflation by a 5-to-1 ratio. Beautiful. Beautiful leverage. Yeah. It's, Archimedes said, give me a lever long enough and I will move the entire world. And he was right. Leverage is an incredibly powerful tool. So one more cycle. Now this portfolio is worth $8 million. You've got a $7 million gain. You go to the bank, you say, give me loans for $6.4 million. You again have doubled your equity position from $800,000 to $1.6 million, and you now have $3.2 million in cold hard cash. And you take that $3.2 million, hopefully you're going to invest it and make a great return on it. But in this example, just stick it under your mattress and earn 0 return on it and divide by 12. And you've now got $250,000 per year tax-free on which to live. That's for your lifestyle. Over $250,000 tax-free, that is probably the equivalent of about $350,000, roughly somewhere around there, in taxable income. I mean, where else can you do this? And, look, this doesn't even take into account all the tax benefits you may have taken advantage of over the years, all the positive cash flow you've hopefully taken advantage of over the years. Just there are so many multidimensional aspects. This is just a very simplistic example of how to extract wealth from the portfolio. Refi till you die.
Yeah, that's the beauty of it. And anyone can do it, right? You don't have to be you don't have to be Donald Trump to do it, right?
Well, Donald Trump does do it, but yeah.
Right, exactly the point.
Right, yeah. And one more thing I want to say to your listeners. If you think 12 years, that's a long time. Well, you're right, okay? So you can do that same refi till you die on a 7-year cycle. And in 7 years, by the rule of 72s at 6% appreciation, very modest and historical, your portfolio goes up in value by 50%. So you could do 7-year cycles. I don't know what will be the best cycle. You just have to gauge it at the time. But this is how people create so much wealth through income property. And, of course, not to mention the huge tax benefits available to serious investors. You become a real estate professional status, and that's an IRS status, not like you're selling real estate or anything. You take unlimited passive loss deductions. It's the most historically proven asset class in the U.S., if not the entire world.
It's a beautiful thing.
It really.
Jason, on that note, we got to go, but we find you at jasonhartman.com. What about your plethora of podcasts?
So the podcast. Yeah. So just type my name on iTunes, Stitcher Radio, SoundCloud, Jason Hartman. You'll find my podcast there or at jasonhartman.com from right on the website. And Kerry, I'm going to send you the PDFs of what we talked about so that you can put them in the RSS feed and post them on your website. Okay?
They will be there for you to download at your pleasure. Just check it out on financialsurvivalnetwork.com. And somehow there's a way of doing it when you download the podcast directly, but we'll have them up there for you for your perusal. And send us your feedback and let us know what you think of Jason's strategy. I mean, Jason's been doing it for years, and it's definitely worked for him. So let us know what you think. Anyway, Jason, we'll talk to you again soon. Be well.
Thanks, Kerry, and happy investing to you and your listeners.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.